America's back in business, at least for the next 2 months.
I will sign a law that raises taxes on the wealthiest 2% of Americans, while preventing a middle-class tax hike that could have sent the economy back into recession and obviously had a severe impact on families all across America.
257 to 167, the House approves a bill raising taxes for the wealthy and delaying spending cuts for 2 months. Economists had warned that if the US fell over the cliff, the resulting reduction in consumer spending could have sparked a new recession. But there is another battle ahead. What to do about the government's $16 trillion debt pile?
We can't not pay bills that we've already incurred. If Congress refuses to give the United States government the ability to pay these bills on time, the consequences for the entire global economy would be catastrophic, far worse than the impact of a fiscal cliff.
All right, let's look at some market reaction. Asian equities taking off on news that this drama has ended, at least for now. Stocks hitting a 5-month high across the region. Let's get to Tara Joseph in Hong Kong. Tara, is there a palpable sense of relief that this has been done now, or are people more worried about what's to come?
I think it's like drama over risk on type. Everyone who's around, at least, because a lot of people are still on holiday, are piling into the markets and into risk-related access, such as crude, which is going up, and also into the stock market, especially Chinese stocks.
All right. What are the communist papers in China saying about what has happened? What take are they putting on this?
Yeah, you know, it's interesting. The Chinese are used to getting needled by the U.S. press all the time, so I think they're having a little bit of fun with this one. Here's one quote from Xinhua saying that the political gridlock in Washington really looks ugly from an outsider's perspective. They're telling Washington to get their house in order because they're messing up the world economy, and it's their chance to sort of get back at the U.S. for all the negative articles we've seen.
And let's face it, there are a lot of people here would say they're not wrong. This debt ceiling issue is something that could mess up the world economy, right?
That's right. So as you were saying before, what's the feeling over here? Yes, short-term rally to pile back into the markets, but economists are, well, they're pretty cynical, actually. One really respected person here in Hong Kong today was saying, yeah, this is great, but we're up for the triple cliff in March when we come up against more budget deadlines, and it's going to get worse. And at the end of the day, Asia looks really good because compared to Europe and the United States, budgets here are swelling with money, and there's money pouring into Asia on that notion.
All right, Tara, thanks a lot. Investor appetite, as we just heard, for risky assets buoyed by the end of this crisis. Also affecting currency markets, of course. Stephen Saywell is Global Head of FX Strategy, BNP Paribas. Morning to you, Stephen.
Good morning.
What camp are you in? This short-term relief, or really glad that we've got this done now?
Well, I would say both, really. Clearly, there's short-term relief, and we've seen for the past couple of weeks a risk-off approach in markets where the riskier currencies, such as Asian currencies, the Australian dollar, even the euro, have suffered, and the dollar has benefited as a safe haven flow. But given that we've got this result now, we've got an agreement, the market's more likely to put risk on. We think the dollar's going to sell off. We think that it's going to see a reversal of those moves of the past few weeks. So we like Asian currencies, we like the Aussie dollar, we like the euro.
All right, how long do you stay out of the dollar then?
Well, we tend to think most of the year because we don't think the fiscal cliff is the real story. We think the Fed is what's driving things. Mr. Bernanke has announced significant balance sheet expansion, printing of money. That's going to keep the dollar weak.
So, and where's your euro-dollar call now?
Well, we've got euro-dollar moving to 135. That 6 months ago looked like an extremely, well, even crazy call. Now it's fairly conservative. I would say the risk to that is slightly higher. But again, it's probably not the best way to play dollar downside. I think Asian currencies, I think the Aussie dollar, even sterling are likely candidates for outperformance here.
You know, of course, all this fiscal cliff talk has meant we haven't talked as much about what's going on in Europe. When do we really start worrying about Europe again and getting out of the euro?
Well, I think the risk in the Eurozone has shifted. Certainly 6 months ago, we were nervous about tail risk, Greece leaving, potential even breakup of the Eurozone. That is now not a risk. I think the problem in the Eurozone is low growth, and that's going to be with us for some time. But in an environment where the Fed's printing money, I think the dollar wins that battle, so the dollar remains the weakest, the euro goes up, but the real trade here is that euro underperforms on the crosses. So euro will underperform Aussie, it will underperform sterling.
Just to come full circle again, I mean, you seem really positive on this news out of the US. Does it not worry? Does the debt ceiling issue not worry you? Does the spending cuts issue not worry you? When do you start to worry about this stuff again?
Well, I think it's interesting. The US has taken a very different approach to Europe. Europe is all about austerity, about fiscal consolidation. The US has said, we're not going to worry about it right now. We're going to bet on growth coming back. We tend to think growth will come back in the US, but there will be some fiscal issues. So we wouldn't be surprised to see the US downgraded again, and that may keep the dollar relatively weak. But as we've seen before in foreign exchange markets, sovereign downgrades aren't big drivers of currencies. Markets are much more interested in growth.
Stephen, thanks a lot. Stephen Sewell, BNP Paribas. Right, social pulses, I'll look at what people we follow are reading. Twitter, as you can imagine, buzzing with fiscal cliff reaction. You can see a bunch of stuff here. Hashtag fiscal cliff is trending on and off, has been trending on and off all morning. Generally positive comments, a lot of tweets regarding the positive market reaction, a victory for the middle class. These are tempered, though, with worries over the debt ceiling, high jobless rates. Good piece in the Washington Post on that. Also, the hit on small business is much discussed. You can see some of the tweets running across the screen live there. You know, there's 20, 30 coming through pretty much every 30 seconds or so. Now, a complete rout by the Democrats was one we just saw there. What the fiscal cliff could mean for the FDA. That's a Forbes piece coming through there. Pelosi playing a key role in preventing any entitlement cuts this time around. So get your views there on Twitter. It's coming in hard and fast. That is it for now. Our Reuters pick of the day. The wink that says it all. The president preparing to tell the world a deal has indeed been done. I'm Axel Threlfall. This is Reuters.